Toronto home prices are back to pre-pandemic levels, inventory is exploding, and forced sale listings are surging. Right now, we're tracking hundreds of forced sale listings, with single family detached leading the charge. And GTA delinquencies are up 7x from their lows. Unemployment is pushing double digits. This is the stress test for real. And no, to answer your question, power of sale does not equal foreclosure. So you're not going to steal a house, but if you know where to look and how to negotiate, there are some cracks and with it, opportunities. And I know this is a long video. Please stick around because there's something that you're going to want to see. I took the time to personally aggregate over 4,000 power of sale listings. And then I used our AI to comb through every single one of them. And after going through the data, I want to tell you what I discovered that points to a potential for financial contagion in Canada's housing market. My call, the real pain peaks in late 26, early 27. And the market doesn't truly turn until we hit peak unemployment and peak delinquencies. And they usually move in tandem. Let's get into it. Toronto's real estate market is really sending mixed messages. On the surface, some metrics don't look too dire. For example, home sales in August were actually up slightly year over year. And just this last week, the Bank of Canada delivered a small interest rate cut, hinting at some relief for borrowers. But if you dig deeper, you'll find some major red flags. Average home prices have fallen 5% year over year to 10% across the GTA, depending on the asset class. Inventory is soaring. Active listings are near record highs and will probably hit another record in September. Unemployment in the Toronto area has spiked to 10%. And you can see a clear correlation when you look at Ontario unemployment rate versus mortgages in arrears. And power of sale listings, basically Canadian foreclosures, have exploded in number. In short, financial stress is mounting in Canada. Today, I want to talk you through the data on distressed sales. I'm going to explain what a power of sale means and doesn't mean, who's getting hit the hardest, and I'm going to share my outlook on where this might be headed. So if you are a bit of a nerd when it comes to real estate data like me, buckle up because we have a lot of charts and data to cover. Now, a quick note, this situation isn't coming out of nowhere. I've been tracking the rise in distressed sales for a while. October of 2024, this time last year, I was literally quoted in the Toronto Star about the uptick in power of sale listings, and they featured my data in this article here. And at that point, they were up 112% year over year. And I flagged that trend early, and some of us in the industry even started sounding the alarm. Even some of the more popular GTA real estate YouTubers, like my good friend Jordan Skrinko, put out videos in 2023 noting that foreclosures were rising. And this is actually Jordan's most viewed video, and it features one of the charts that I'd created. And so while the broader public and media are just now catching on, those of you who've been following my content for a while know that I've been on top of this from day one. I take no pleasure in being right about a wave of distressed sales, but this is really important context because this has been building for some time now. So the first thing I want to do is clarify what a power of sale actually is and how it differs from the classic foreclosure that we might know from US real estate dramas. In Canada, power of sale is the main legal process that lenders use when a borrower defaults. The lender does not automatically seize title of the home, as in a foreclosure. Instead, after giving required notices and waiting periods, the lender gets the right to sell the property. An important piece of this is that the lender must try to sell at fair market value. It's actually a legal obligation that they have to advertise and list the property on MLS like any normal sale. And if they sold it too cheap, the buyer could sue for damages. So in practical terms, you're not going to find banks dumping houses for pennies on the dollar in the Ontario real estate market like you did during the 2008 downturn. A lot of buyers, especially the ones who have been bearish for a long time and waiting on the sidelines for a housing correction, they hear foreclosure and they start salivating, thinking that they're going to steal a property. But the reality is quite different here. The bank's goal is to recover what they're owed, not to own the house. And any extra money that they make from the sale after paying off the mortgage and legal fees actually goes back to the original homeowner and or their other creditors. So the bank isn't really trying to make a profit here. They're just trying to cover their debt. So let's temper our expectations here a little bit. Power of sale listings aren't automatically amazing deals for buyers. Yes, they are distressed sales, and yes, they're an important metric in that regard. And sometimes the pricing will reflect a more motivated seller who's the lender. But if you remember, a lender is probably a more sophisticated seller than your typical homeowner you're dealing with. In fact, somewhat paradoxically, a power of sale label on a listing can attract a lot of bargain hunters, meaning more eyes on the property and potentially more offers. I've actually seen cases where power of sale listing ended up selling for a normal market price or even a premium because so many buyers thought they'd score a deal. So don't assume that a power of sale is going to be a 50% off fire sale. The bank must try and get a fair price, and in many cases they do. And they aren't really ever in a hurry because any interest accrued during the period that is unpaid by the original borrower gets added to the damages that they can later collect from that borrower, assuming that it's not a blood from a stone kind of situation. Now, there are some fringe cases here, and I would say the majority of power of sales aren't your sophisticated lenders. So if you are hunting for distress sales, here's how to actually find them. Most power of sale properties end up listed on MLS, but it's not always labeled properly. There are a few methods that professional investors and agents like myself use to spot these listings. And I'm going to go through what that looks like. So the first thing you can do is search in public remarks on real estate sites like realtor.ca. You would think that in the keywords, you can just type in power of sale and it'll give you a relatively small cross section of what's available. Now, that's going to get you about a quarter of the total supply. This will catch some of the listings where the agent explicitly mentioned it in the description that's publicly available. Like, for example, this property is sold under power of sale. This method typically doesn't capture everything. My brokerage's website, valery.ca, we have a search tool. I'll put a link in the description where you can actually just check a box to filter by power of sale listings. Our methodology, which still uses that public remarks feature, captures about 1/3 of the total power of sale inventory. Now, a lot of listings mention power of sale in what's called broker comment. This is private notes that are only available to realtors in the back end. So if I bring up the same map area, I'm getting about 245 searches of this nature when I put it in the broker remarks. So you get about 2/3 of the total supply using that search criteria. And this will help you uncover a little bit more distressed listings. It requires a realtor to do it, but it captures a little bit less than twice as many as the public search does. And agents will sometimes keep the power of sale part off of the public remarks and just keep it in the private remarks to protect the privacy of the seller. Now, the final pro way to do this is actually to search in the seller name. And you can search the term power of sale in the seller name, and then you can also add in every single Canadian lender by name. And I would still say this probably isn't going to capture 100% of the power of sale listings available in the market, but this is the closest that you're going to get in a mass search ability. And if you want to get on a list for a search that is this thorough, if you click the second link in the description, it'll actually just send you this list on a weekly basis as new power of sales are added. Like fellow real estate YouTuber John Flynn and my colleague and one of my favorite YouTube channels, Rob Marsiglio, who's actually an agent at Valery with me, who have sort of been thought leaders in this space. We've been monitoring the true scale of distressed listings. And speaking of scale, let's talk numbers because they have gotten pretty wild. And that's what you're here to hear about. By any measure, for sale listings are spiking hard in the GTA. New data shows that as of early September 2025, there were at least 228 active power of sale listings in the GTA, up 59% from the same time last year when there were about 143. And Rob Marsiglio tracked these numbers directly from the MLS system. It might be even higher, though, based on this article that featured both Rob Marsiglio and John Flynn. John mentions that the count is about as high as 780 active power of sale listings across the GTA. This means that you have a lot of distress in the market. For context, in more normal times, the percentage of listings under power of sale would be well under 1%. So this is a really noticeable blip. To put it into historical perspective, let's recap the trend over the last few years. So during the pandemic boom, foreclosures virtually disappeared, right? There was cheap money, rapidly rising prices, meaning that anyone in trouble could just sell or refinance. In 2022, there were on average only like 4 power of sale listings per month in the GTA, practically nothing out of the thousands and thousands of sales. In 2021, that crept up to about 33 per month and then 38 per month in 2022. And by 2023, we had jumped to around 83 per month on average. And in 2024, we were seeing around 160 new power of sale listings per month, by far the highest in recent memory. And the Toronto Star reported in the article that I was in October of 2024 that September 2024 had, at that point, a record 204 power of sale listings, which was more than double September 2023. So yeah, we've seen an upswing for a couple of years, but 2025 has actually kicked it into an even higher gear. And a lot of folks in the industry are even comparing this current climate to the 2008-2009 financial fallout crisis, where the US housing market crashed. Now, to be clear, we are nowhere near the US foreclosure rate from 2008. 0.3% of mortgages are in trouble versus 3.3% in the US, are very different scenarios. And Canadian law, at least not in Ontario, doesn't allow for jingle mail walkaways like some US states did. Borrowers here remain on the hook for any shortfall after a lender's sale. So they can't just forfeit the house and then the bank has to sell it for pennies on the dollar. So I don't think this is a 2008 redux. I don't think that Canada's market really allows for that to take place. But this is easily the most strain that we've seen on the GTA in over a decade. Now, you might hear some experts downplaying the foreclosure surge because in percentage term, it is still a tiny slice of the market. But even in the US, it was only 2 or 3% of the market that really started that first downturn. And so far, these experts are right, but it doesn't mean that there are no implications long term. Even now, 3% of listings power of sale means 97% normal sale. Mortgages in arrears across Ontario also remain historically low, about 0.16% of mortgages province-wide as of mid-2024. And I just did a recent video on the most recent Equifax data. They're the highest in Ontario and the absolute highest in the GTA, but they're still relatively low because of the Canadian Mortgage Charter, which makes it so people don't really have to, if they're in a delinquency situation. Like if you're going to show up on a big 6 bank's books as a 90-day delinquency, you have to be like deliberate, ghost every single phone call, don't take any of the options that they give you to keep you off of their books. And so the market has really been managing to stay afloat, and the overall market hasn't yet really been flooded by default. But I think that this is one of those things that it gets trickled out over time, which is probably worse. You almost want to see that big crash. Like think about the big crash that we saw in 2022. You really get that restoration of affordability quickly. Buyers get interested in the market again because prices are compelling. Whereas that slow grind down, buyers are like really, really patient because the long-term downtrend tells them, well, I can just wait, right? So should we ring the alarm bells here? Maybe not for the entire market yet, but let's not gloss over it either. For each family behind these listings, it's a personal financial disaster. People's life savings are getting wiped out. Their net worth is diminishing. Each power of sale represents someone who hit a financial wall. This is often a very painful and stressful situation. I think a lot of people who are bearish don't have a ton of empathy for people like that because they've felt the same victimization by being left out of the market. And so it's really a double-edged sword, right? Like the market victimized just as many people by going up and reaching unsustainable highs. And now it's going to victimize just as many people by getting back to normal. I don't think either party should be wishing for the other's demise, but you had the people when the market was running away saying, have fun staying poor. And now you have the people when the market is crashing, laughing at those who participated during the bull run. And distress tends to feed on itself. If new forced sales start to happen at lower prices, this can push overall prices down, which erodes equity for others and potentially creates more distressed sales. So it becomes like this deflationary, self-fulfilling prophecy. And I think that 1%, even just 1% of listings being for sales can start puncturing the market because the lower price sales set the comparables, which drags down the neighboring values. And this can become self-perpetuating if it snowballs. So it's the trend, not the current market share, that has me and other people on alert. And this is why I've been paying attention to this data for so long. In fact, a lawyer who works with private lenders commented that the court system is getting backed up with power of sale filings on this Reddit thread, and that the number of lenders trying to get possession right now is staggering. And he suggested that official listings don't even capture all of it. And I've had a lot of people from banks reach out to me, and whenever I present this power of sale data, they'll say, hey, I'm from X bank that I'm not going to mention, and we don't actually require that the seller, in a power of sale, we actually don't require that the listing agent puts bank of X in brackets under power of sale, because that's negative PR for them, right? And so they can actually just list the property in power of sale situation in the seller's name. And so the number of properties that are actually probably distressed sales is likely vastly understated. So why is this actually happening? Let's unpack this surge in distress here. It's not one single cause, but it's a convergence of factors all hitting at once. So number one is interest rates skyrocket. And this is obviously a big one. In 22 to 23, the Bank of Canada hiked rates at the fastest pace in decades. We haven't seen a tripling of the interest rate since the 1990s, the last time we saw a housing correction of this magnitude. So borrowing costs have stayed high. Many homeowners went from mortgages in the 2% to 5% range. So if you had a $600,000 mortgage that was $2,800 a month at 3%, it becomes $4,200 a month at 6.5%. And during that 3-year, 5-year period of time, all of your lifestyle expenses went up. All of your grocery bills went up. Your car payment likely went up. Your insurance payments went up. Your gas bill went up. Inflation, in combination with that higher interest rate environment, is really putting stress on households. It doesn't happen instantly, right? It takes time for people to reach their limit. 1 month goes by and you start cutting into your savings, and a couple months go by and you've run out of savings, and then a couple more months go by and you start covering expenses with credit cards, and then you can shuffle stuff around, and then you drain your HELOC, and then eventually you run out of options. With every day that goes by, more and more people run out of options. It's not like you can go start a business or get a job really easily because unemployment's getting really bad. And so households simply can't absorb these costs. According to a recent BMO report, 2/3 of mortgage holders renewing now are facing equal or higher payments than before, despite even the rate cuts that we've seen since then. So the payment shock piece is very real. The next piece is the renewal wall. Many people who bought or refinanced in 2020, 2021 at rock bottom rates are coming up for renewal this year and next year. 60% of mortgages are going to renew in the next 365 days or by the end of next year. So we're talking tens of billions in mortgages hitting their 5-year term end or 3-year term end. I think like 15 to 20% of RBC's mortgages renew over the next year or so, according to their disclosures. So we're just entering this wave now. And every month, more households face the harsh math of renewed payment that they can't afford, forcing them to consider selling or defaulting. This renewal wave is a major reason I expect distress listings to keep climbing into 2026. The other big piece is that there's no equity cushion for recent buyers. Toronto real estate had this incredible run up for decades, such that like 90% of buyers historically saw price gains within a year or at least within a mortgage term. And that meant that if you got in trouble, you could often refinance or sell and still clear your debt thanks to rising equity. But this isn't the case anymore. Prices have fallen back to 2021 levels, which means that it's great for buyers who wanted 2021 prices, but terrible if you bought a home after that 2021 level or 2022 peak prices. Anyone who purchased in the last like 3 to 4 years likely has little to no equity or is even underwater, which means that they owe more money than the home is worth. And this is especially true in the pre-construction market right now, where I've already done videos on how far equity negative and cash flow negative most of these units are. And so these borrowers have no equity safety net. And when I get to the composition of power of sales and you see who has been lending most of the money that's going delinquent right now, you're going to see how this can become a financial contagion. People can't refinance out to pull cash out to consolidate debt. They can't easily sell without potentially taking a loss. Earlier generations rode the equity gravy train, but newer buyers are stuck. And I presented this in the most recent video from Equifax, where the newest mortgages are going delinquent the fastest. And this is exactly what we're seeing. Law clerks and insolvency trustees report that far fewer of their forced sale cases have any money left over. One veteran law clerk noted that 70% of their files used to have money left over after a power sale, and now more times than not, they don't get any money. In fact, lenders themselves are sometimes taking losses, especially on condos. This law clerk mentioned that it was rare for a lender to lose money on a mortgage sale, but now in the condo market, it's increasingly normal. And she checked a recent file, and the lender was facing a $200,000 shortfall. Recently commented on a post that I put up about the power of sales by lender type. And he mentioned that in his work lately, privates are getting wiped out. So these are your second mortgages where, maybe they, in 2021 or 2022 at the peak, they were comfortable lending behind a mortgage of 800,000 up to $1 million because the house was worth 1.2. But now if the house dropped 200K in value and it's only worth $1 million, or if it dropped even further, let's say it's only worth 900K, now all of a sudden there's no equity there. And if that borrower goes delinquent and they have to take the person power of sale, the first lender is fine if they're only up to, 700K. The lender who's behind them in second position starts losing capital. And in many cases, they're getting wiped out. And so if lenders are eating a loss, this is where they're realizing that negative equity in the risk position. Even the lenders can't fully recover, which, we're truly in uncharted territory when even the banks or private lenders might be losing six figures on a condo sale. And it's not just interest rates. The job market has softened, especially in the Toronto region. The GTA's unemployment rate is pushing 10%, the highest since at least 2016, aside from obviously the brief pandemic shock. And we've seen layoffs in some sectors and a rise of gig, contract, and part-time work. With job losses comes more delinquencies. It's very tightly correlated. And it's been observed that job losses are typically an early warning sign on delinquencies. So people might have scraped by at 5% rates with a job, but they definitely can't do that if they lose their job, as well as absorbing all of those higher costs. And so that expedites that wall that I mentioned people hitting, where they just kind of run out of options and they have to go delinquent. They can no longer keep their head above water. A recent trend that I'm hearing about from insolvency professionals is that, unlike prior cycles, a lot of working class middle families are now showing up in debt trouble. And this is because Canada has an obsession with credit. And we have this phenomenon called debting ahead. We see our neighbors have the nice car and our friends have the nice car, and we feel like we need that. And even if you go to a used car dealership or a new car dealership in Canada, most of these guys make their money on selling credit, not selling the cars. They're loan originators. Everything in Canada is financeable. And so we have this inability to defer gratification. And so we want all of the enjoyment today and we suffer in the future for it. You're borrowing against your future self when you go into debt to buy something, right? You still have to pay that back with interest in the future. And now we're getting to the pay it back phase of the credit cycle in Canada. And it sucks and it's painful. And this is the consequence when you get to some of the highest debt to household disposable income in the world. One of the experts in this Reddit thread noted that for 10 years, they didn't talk to a homeowner because rising prices bailed everyone out. But now all of the people coming to them with these debt problems are teachers, firefighters, cops, coming in over leveraged and unable to pay their debts. This is a huge red flag. It means that stress isn't isolated to a small subset or kind of like the lower middle class. It's hitting the broader middle class. We also can't ignore the investor factor in Toronto's market. During the boom, tons of mom and pop investors bought rental condos and pre-construction units, hoping appreciation would continue to bail them out. And now those bets are going wrong. In the GTA, condos currently make up like 28% of power of sale listings. And in the city of Toronto, condos are about half of all power of sale listings. And many of these are investor properties. If you live in your home, you'll sacrifice everything to keep your roof over your head. You cut expenses, maybe even go delinquent on credit cards or your auto loan or whatever before you default on your mortgage. But if it's an investment property and it's already bleeding cash, you're way quicker to let it go, especially if you have multiple investments. And debt counselors are seeing a lot more amateur landlords in trouble, people who maybe could have managed one rental, but instead bought 2, 3 or more condos, and they're all cash flow negative. And Scott Terrio, who I mentioned, has seen a lot of people who have 3 rental properties, and they would have been fine if they just hadn't done it. Rents went up, but not enough, and now they're coming down. And many of these units were already cash flow negative. They barely covered the ultra low interest payment, And now rates are high, so carrying costs far exceed the rent. And so I think a lot more investor pain will come, predicting that we'll see the biggest insolvency year ever once all this debt unwinds. And for reference, 2009 saw a record 160,000 insolvencies in Canada, which is personal bankruptcies plus proposals. So far, January through July, we've insolvencies in Canada on track to surpass 2024's total of 143,000, and will possibly approach that 2009 record. So yes, investor defaults and real estate bankruptcies are a big part of this story. This is what allows people to, like, the real estate asset just allows people to pack on so much debt. And debt's great to the upside because it magnifies your returns, but it's also brutal to the downside because it magnifies your losses. It's really a double-edged sword that way. A lot of people don't realize when they're getting into real estate investing that you're really getting into a huge liability. And that's why it's such a double-edged sword and why you're playing with fire when you're doing this. A special subcategory of investor distress is the pre-construction market. In hotter times, many people bought pre-con condos or houses with deposit money, planning to either flip the contract, assign it, or close and rent or sell at a profit. Now a ton of these projects are completing, and guess what? The unit appraisals are coming in lower than what the buyers agreed to pay. There's nobody lining up to take these assignments. If you go to rent them out, you're cash flow negative. And when you close on the unit, even if you can figure out a way, you're closing into a huge equity loss. Some people are walking away from deposits, which they risk being sued. Others are trying to sell assignments at a loss. There are reports of like dozens of assignments in some buildings and even units selling on assignment at 2018 or 2019 prices. One lawyer mentioned that he had seen many clients who paid a deposit on an investment pre-con property and now can't close because the value fell and no bank will finance the shortfall. And actually, there's an interesting story coming out of Oakville where a project on Bronte actually marked down their inventory units, so any leftover units that they had, to basically market value. So the pre-con buyers bought at like $1,100 a foot, and they marked it down to, I want to say $675 or $700 a foot. So basically dropping the values by like 39%. And so all of your pre-con buyers are basically like protesting this decision, and there's a Facebook group about it, and people are really pissed off. There are a lot of consequences to this whole speculative model that was created, and both the buyers and the sellers, the builders, are trapped, as well as the lenders in these situations in many cases. And builders themselves are slowing down launches now because sales have dried up. And this will ultimately constrain future supply, which some people would argue is bullish long-term, ironically. But in the near term, the pre-con sector is on life support. And this adds more distressed sellers. Some buyers are opting to close and then quickly list their brand new unit for sale. And when you do it this way, you can actually realize the capital loss. If you do it as an assignment and take the loss in an assignment, you can't actually realize that capital loss. And so these people, I would say, are essentially becoming forced sellers because they never truly wanted to hold the unit. And this is forced sales that exist outside of even foreclosure or power of sale. And others are going straight to default. So there's many different layers of these forced sales that don't even actually show up in the data. And this is where we get to the really interesting part, which is who the lender is. A lot of power of sale listings that we're seeing involve B lenders or private lenders, not the big banks. This is an obvious thing, right? Why? Because private lenders charge 10 to 15% interest, and their borrowers were often folks who had already taken higher risk, maybe had poor credit or high debt ratios, couldn't get an A loan. And with rates up and housing down, these deals are the ones imploding first. And there's a special category of private lenders who are seeing the most delinquencies. And private lenders don't really mess around, right? If you miss payments, they will invoke power of sales much faster than a big bank. They're not beholden to this mortgage charger that I mentioned in one of my most recent videos, where they really have to be nice to you and try and help you work it out. They're also not under the same regulatory or PR pressures. And so I actually took the time to go through all of these power of sales, and I found a really interesting piece of data. I kind of expected that this was going to be the case, but I didn't realize that it was this profound, how much exposure there was in individual private lenders. This is the part that almost nobody is talking about, and I know why, because it took me a day to go through all of these listings. There's literally 4,000 power of sales since the beginning of 2022. We went through every single one, pulled the lender names. Now, the vast majority of power of sale filings are coming from what I would call individual private lenders, not the big six bank. In our parsed MLS data set, roughly 2/3, 66% of all power of sales since 2022 and 65% of active power of sales right now were initiated by individual private lenders. Mix and other institutional privates are a distant second, with B lenders and the big six each accounting for a much smaller share. So who are these individual private lenders? In plain English, these are regular people, often set up as a numbered company or just as their individual name, who decided to lend money secured against someone else's home. You could think of them like mom and pop landlords, except in this case, they're mom and pop lenders. And instead of buying a rental, they bought an interest payment. During the boom, a lot of folks ran a simple strategy that worked until rates exploded. The idea of a carry trade. And I call this, actually Ben Rabideau came up with this term. It's called the Canadian carry trade. And a carry trade is just borrowing money at one interest rate and then relending it at a higher rate. And this is how people did it in Canada, much to their detriment. Although many people won with this strategy for the last 20 years. So step one is in 2020 to 2022, you borrow money against your house or your investment property on a variable rate HELOC at very low rates. Step two, you lend this money out as a private mortgage at 12% interest rate, probably, plus a 2% lender fee, getting you to probably 14%. That 2% is origination fee, maybe private lender, broker fee, whatever. So you end up capturing like a 7% plus spread. You're making 7% per year, roughly, let's say for a year. So on 300 grand, that's $21,000 before fees and taxes. Then the shock happens. Rates jump up 50% as the Bank of Canada hikes. Your spread shrinks from 7% to 2 or 3%, or even worse after legal costs, vacancies, and non-paying borrowers. And step 6 is the borrower can't refinance out of the private loan in a down market and they miss payments. And then the final piece is your private loan goes delinquent and you take this power of sale. And this is an especially bad position to be in if you also did that loan in 2021 or 2022 on a value that was really, really high. Because not only are they missing your payment, the loan is probably also equity negative, which means that you're at risk of losing principal as a lender. And if you're in second position and the first lender takes it power of sale, they don't care about protecting your principal. And this is why I recently did a tweet about how the Canadian carry trade is getting blown up. And there's one more step that's critical in today's market, which is no equity if the property was bought in 2021 or 2022 and prices rolled back to the 2021 levels or even lower. So there's little to no equity buffer to bail these things out. Most individual private lenders sit in second position behind a first mortgage. In a power of sale, sale proceeds first pay property taxes, legal, realtor fees, then the first mortgage, principal, arrears, and fees, and then the second private mortgage gets paid. If the sale price doesn't clear the first and the costs, which is common with peak era purchases, then the second gets $0. They get wiped out. And remember, I mentioned the carry trade. The second position, private, is often borrowed from their HELOC to fund that loan. So even if they recover nothing, they still owe the HELOC or mortgage on their house against their own home. And this is how damage spreads back to primary residence or investment properties and how it becomes economically contagious across the entire housing market and why this matters beyond a handful of speculative borrowers, because 66% of those loans are people who have exposure to other real estate. And even if it's only 20 to 50% of those individual private borrowers, that's still a lot of people. If it's 60% of these loans, that means like a quarter of all power of sales are also exposed to somebody's primary residence through a HELOC or investment property through a HELOC. And this is where contagion happens. Why does this matter for the broader market? Number one is it's forced deleveraging. Mom and pop lenders take the losses. They stop writing new loans, which means more credit contraction, more distressed borrowers, less people who can get bailed out by inexperienced lenders. Number two is the sentiment hit. Stories of regular people losing money on private mortgages spook both investors and would-be private lenders. And number three is the phase change risk. If stress mitigates from private lenders to Main Street banks, like you see power of sales start to rise for big six, like, you know, in the Big Short, when you kind of go through your crappy tranches of loans first, typically a later cycle signal is you'll start seeing it rise in the better quality loans will start going delinquent as well. This is something that I've been really watching closely in our quarterly power of sale reports. The bottom line here is that the data isn't primarily a banks gone wild story. It's mom and pop credit story gone wrong. This is your mom and pop lenders who are the ones really feeling the pain of this. And this is how it trickles out into their houses and their investment properties and their personal finances. And this is why I think it's a much more long-term story and impact than a lot of people think. This is why I expect distress to keep climbing until we burn through this cohort of private loans and the renewal walls behind us. So now let's briefly describe what actually happens when a home goes power of sale, because I think it's helpful to demystify this a little bit. Say an owner stops paying a mortgage. The lender issues a notice of sale, giving them typically 35 days to catch up. Forbearance measures, like you can try and sell your house and show us that you've done it. And this is why the big six have much lower delinquency rates than anyone else. The notice of sale typically gives somebody about 35 days to catch up. And if they don't, obviously many people who are delinquent can't, after that period, the lender can proceed to sell the property. They'll often get a court order if needed to possess the property, also known as a writ of possession, and then they'll list it on MLS through a real estate professional. The MLS listing will usually state the seller name as the lender's name, and then in brackets under power of sale. And then the remarks typically will say something like Schedule B to accompany all offers, which is the bank's addendum of conditions, like the property is going to be sold as is, there are no representations and warranties made, and the lender has no liability for property condition. And this is where some of the risk starts. If you're actually buying these foreclosed properties, you want to make sure that you get an inspection and do a really thorough viewing of the property, because in a lot of cases, the person selling it to you hasn't actually owned, or in many cases even been in the property. And so they really can't make any representations about the property to you. And as a buyer, you can absolutely put in offers on these like any sale, but you want to be prepared for a little bit more paperwork and definitely a slower process, because banks and lawyers aren't really known for being quick at responding, and they often insist on certain terms to protect themselves. So it's harder for you as the buyer to get terms to protect yourself. An important piece to note here is that the borrower, the original owner, still has the right to redeem the mortgage and stop the sale right up until it closes by paying everything owed. It's pretty rare, but it does happen. I've seen it happen once in my career on a power of sale. Maybe a family member bails them out last minute, or they see the sold price on MLS and realize that they might have more equity than they expected, and can go get a private loan to try and bail them out. And in those cases, the deal would be nullified, which is another small risk of buying a power of sale. It's not super suitable for somebody who is planning to move in at a specific closing date, because that closing date could change and the house could actually just get taken away from you. You would get your deposit back and all of those things, but you wouldn't get the deal. And if the sale does go through, the lender takes their cut, which is the loan balance and legal fees, and then any remainder would go to the borrower. If the sale doesn't cover the debt, the lender can pursue the borrower for the difference. So they're somewhat motivated to try and get market value, but they're eventually, if they can substantiate through a negotiating process that they really tried their best to protect the value of the property and went back and forth with you, they will eventually let the property go. They're not going to fire sell it. And this is why you'll often see powers of sale spend a lot more time on the market, and they'll take really long to negotiate. And in many cases, if the borrower ends up having that debt collected, you'll see borrowers in bankruptcy to wipe out that deficiency. We've seen cases where, say, the bank sold a house that was $50K shortfall in the mortgage, and the ex-owner is on the hook for that $50K. And a lot of these gaps are even bigger now than in the past when I've been dealing with power of sales over the last 5 years. If they don't have the money, and it's likely they don't since they were in default, they'll declare bankruptcy to be released from that debt. So this whole thing can be a financial nightmare for the homeowner, the delinquent borrower. Again, a personal tragedy or investment mistake for them, even if from a market perspective, it's just one more listing. Now, I want to zoom out a little bit to wrap up here and talk about the broader market implications of this wave of distress sales. We've already mentioned that as of August and September, inventory in the GTA is extremely high. I'm predicting that we're going to see a record high month of inventory on the Toronto Real Estate Board in September of this year. And we're up about 40% year over year for active inventory. Ontario and BC have seen listings pile up to decade highs recently. Buyers have a lot more choice now, which means more competition among sellers. We're not in the frenzy days. It's tilting closer and closer to a buyer's market, especially for condos. The sales to listings ratio in Toronto hit about its lowest level since the 08-09 fallout of the global financial crisis, which is a classic recessionary signal for housing. Months of inventory for Toronto condos is north of 5, definitely in buyer's market territory. And even low-rise homes are creeping into balanced market territory. And what, as we know, just basic economics tell us what happens when supply is high and demand is weak. Prices soften, and they have. The average GTA home price is down 23% from the February 2022 peak. And as mentioned, we're hitting those early 2021 and even approaching 2022 sale prices. In some one-off cases, we're seeing 2016, 2017 sale prices. Median prices are similarly down. Bidding wars are few and far between now, except on the extremely rare, well-priced or unique property. And this rise in distressed listings will further contribute to price weakness in a few ways. Number one is more inventory. Every power of sale listing that hits MLS is an additional listing, often one that wouldn't have been on the market otherwise, since the owner didn't likely want to sell. So we're seeing total listings climb rapidly while sales volume is sluggish, which widens the gap here. And we're already at a record spread for August between the number of active listings and the number of sales. The other thing is the fact that it can create a lower comparable. A lender under power of sale is motivated to sell relatively quickly and beyond their legal obligation to try and protect the price that the original owner has and not completely wipe out their equity. They're not going to hold out for a pie in the sky price. They'll be very pragmatic about price reductions and negotiation. So typically these listings, if they're not snapped up immediately, will see price reductions on a relatively uniform and expedient basis until they sell. Some have even been selling well below market value recently just to move them. Because every month that goes by, especially if it's a private loan where the interest rate is really high, if a month goes by at a 10% annualized interest rate, the person might as well have just dropped the price by 1% or 2% if it's going to sit on the market for a couple of months rather than accruing more interest. The other piece is the psychological impact. When Jordan posted his video that I mentioned earlier, and it was his most viewed video, people see these headlines of foreclosures, and there was recently 2 articles about it. The one where my good friend Rob was in it, and then Hanif Bayat from woa.ca also put one up on the Globe and Mail. And the reason these headlines get attention is because there's a lot of fear and negativity associated with it, and humans have a negativity bias, and so these bad headlines get the clicks. And you hear foreclosures up 60%, and it dents confidence in the market. Buyers become more cautious, fearing prices will drop further. Sellers get nervous that they missed the market peak and might need to cut their price. And that sentiment can reinforce the cycle. And right now, sentiment in Toronto real estate is quite bearish by recent standards. A year or two ago, most folks thought any dip was temporary and prices would resume climbing eventually. Now, more people are entertaining the idea that this could be a longer correction. In fact, one seasoned market watcher recently said that anyone expecting a rapid rebound in Ontario house prices in the next year is very effing wrong, according to my good friend Ron Butler. So time to take out the crystal ball here. What happens next? Based on everything I'm seeing, I do think that power of sale listings will continue to rise through 2025 and likely into 2026. Remember that renewal wall, a huge chunk of mortgages are resetting over the next 12 to 18 months. And these are going to be renewing at rates that could have huge increases in their mortgage payments. So I think that we're probably in, the 3rd or 4th inning of the total distress that we're going to see across the market. Many owners haven't even felt the full pain of this credit cycle yet because they haven't hit renewal and they were on really cheap fixed rates. And those chickens will come home to roost throughout 2026, unless we see a drastic rate drop. And I mean drastic, like even getting back to the terminal rate sort of expected to be like 200 basis points or 2%. We're not going to go back to that pandemic era low rates. So they're still going to renew, even if rates come down another 100 basis points, they're still going to renew in the 3% rate. And many people will try and hold on as long as possible, burning through savings, maybe taking on credit card debt to keep up. But in 2026, if rates haven't meaningfully fallen, and there are many predictions that they might actually start pushing up based on a lot of the government spending and potential inflationary resurrection, people will start to capitulate. It often takes a couple of years of stress before people finally default. And so that's my timeline guess is we likely haven't seen the peak of delinquencies or distressed listings until another 1.5 or 2 years from now. And it really depends on unemployment as well, because I mentioned that in that chart earlier in the video. Unemployment and mortgage arrears tend to track each other pretty reliably. And this also lines up with a lot of macro forecasts. RBC's economists project that the unemployment rate will peak around late 2025. I'm expecting it to be probably mid next year before it starts to improve. Typically, mortgage delinquencies peak around or just after unemployment peaks, since job loss is a big driver of default, the biggest driver of default. So you get rising unemployment plus high rates equals more arrears. And we're already seeing that. So the $1 million question here is, when will the housing market hit bottom and start recovering? In my view, not until we see the worst of the delinquencies and unemployment. Those are really the two key data points that you want to be tracking. You usually need to see the peak of pain before things turn around. In the early 1990s, Toronto home prices fell for about 6 to 7 years from the 1989 peak to the mid 1990s, largely because interest rates stayed high early on and unemployment peaked around 1992 and stayed elevated for a while. And I don't see our current setup being any different from that. In 0809, the downturn was much shorter, about a year of price drops because rates were slashed aggressively and stimulus kicked in. But even then, unemployment kept rising into 2009 and housing didn't fully regain momentum until that leveled off. This time, the Bank of Canada has started cutting, but very cautiously. We're at 2.5% overnight rate now with the September cut. And there's a lot of prediction that they may pause here for quite some time. I still think we probably have one more cut this year, given the Fed is telegraphing at least one more, maybe two more cuts this year. But I don't necessarily think that that's going to have some sort of profound positive impact on the market. And so prices could and should continue to inch down in nominal terms and drop pretty substantially in real terms because inflation's still reading a little bit high and trending up. On a positive note, most borrowers still have decent equity. The banking system is still stable. We're not really facing a banking crisis, but there's a lot of individual household credit crises. We are seeing a huge increase in supply and a decrease in demand as population growth is tapering off. And so that could create a little bit more headwinds for house prices. So to wrap this whole thing up here, Toronto's real estate market has flipped from basically a record boom to a record strain and the biggest house price drop that we've seen in history. Power of sale listings have spiked dramatically, up 60% from last year after doubling a couple of years ago. It's still a minority of sales, but it's growing and putting downward pressure on prices. The causes of this trend are clear: high interest rates, payment shock at renewals, lack of equity for recent buyers, rising unemployment, and over-leveraged borrowing. Lenders are tightening the screws, especially private lenders, while big banks are extending relief through the Canadian Mortgage Charter, but only delaying the inevitable for some borrowers. It's really hard for people to get ahead once they've become delinquent. And I expect that distressed sales will continue rising into 2026, potentially reaching a peak around late 2026 or 2027 when the lagging impact of these rate hikes and renewals has fully materialized. Home prices are already down 20 to 25% from the peak, and I wouldn't be surprised to see further moderate declines as this inventory overhang and for sale discounting starts to play out. For buyers, this environment could present some opportunities to negotiate. You'll have more choice and possibly find more motivated sellers, including lenders, but you want to be cautious. Catching a falling knife isn't easy, and the best deals might still be further ahead if these trends continue. The easiest way to catch a falling knife is just to wait for it to hit the floor and then pick it up safely off of the floor. And for homeowners, I think the advice is sobering. If you're in financial difficulty, don't wait too long to seek help or consider selling on your own terms. We're seeing a lot of people right-sizing their mortgages at the moment. They don't have enough equity to consolidate their debt. And so what they'd rather do is sell, get a smaller house with a smaller mortgage, and use some of that equity from the downsize for debt consolidation, or basically to pay off that debt completely. So I'm going to keep monitoring the data. I'll update you on the power of sale numbers in the coming months. If you're interested in those weekly distress listings reports I mentioned, make sure you check out the link below and let me know in the comments what you're seeing out there. Are you noticing more for sale signs in your neighborhood? Are you noticing more sales well below what the owner paid for the property? Have you come across a foreclosure listing or even tried buying one? I'm curious to hear your experiences. Thanks a lot, by the way, for your time and for sticking around. I know this was a long video. I tried my best to do a deep dive on the foreclosure topic because I just haven't really seen anybody cover it as exhaustively as I wanted to. I know it was a lot of info, but it's crucial to understand what's happening beneath the headline numbers. I learned a lot from the research of this video, especially seeing how many individual private lenders are the ones taking these properties to power of sale. And that creates a little bit of fear for me that we might have some contagious exposure into HELOCs and other credit products that those people might have been borrowing from to lend that money out. And if you found this useful, please hit the like button and consider subscribing for more real estate analysis. I try and get out as many as 5 videos a week. And as always, stay informed, stay prepared. Let me know if you have any good video ideas, and I'll see you in the next video.